Thank you for joining us today. I'm really excited to share with you Super Stocks 3.0. This bundle of stocks is based on some research that led to a really exciting discovery for us and our own data. You all know our rating system works really well. We found a way to further enhance the rating system, make it even more discerning, make it even more selective, so as to focus on just a handful of stocks that we have seen up to this point perform very, very well. Super Stocks 1.0 outperform the market. Super Stocks 2.0 outperform the market. Some of them by extraordinary amounts. So we're really excited to be sharing with you today Super Stocks 3.0. As always, feel free to ask questions. I want to hear from you in the chat, but let's get going here. Yeah, the title here, Want Proven Stocks. The Super Stock Bundle is back with fresh picks. And as I mentioned, we delivered some great performance so far, and we're excited to share with you our latest. Disclosures and disclaimers. We are not investment advisors. We do not pretend to be investment advisors. We are here to provide research, published research to the public that is there to help you make more informed decisions. And I want to hear from you. Is this your first time with us? What kind of investor are you? In particular, first-time people, feel free to ask questions. We're here to educate. We're here to train. We're here to help you make smarter decisions, and we believe we can do that better than anybody else in the world based on fundamentals. We don't have a magic formula. We don't have a magic crystal ball that makes predictions about how stocks are going to move. We just have better information about profitability and valuation. And keep in mind, if we have time at the end, I will take requests. So have the tickers you want me to cover on hand so we can talk about them. All right, we're here today for a very specific and exciting reason. About 1 year ago, almost exactly a year ago, we launched a special project called the Super Stock Bundle. This was a brand new concept based on the discovery that our analyst team made. We identified specific stocks with a very specific set of criteria that went beyond our proven superior rating system. These stocks were remarkably undervalued relative to their current price and had the potential for abnormal returns in a relatively short amount of time. Today, we mark the 1 year anniversary, and we are officially releasing access to a new set of super stocks. This is a fresh list of stocks that meet our most strict criteria. Why is this such a big deal? Because the results from the last year are in, and they are proven. Super Stock 1.0, the results, huge winners, including gains of 20%. We delivered this one to our clients, and in January of this year, it was up 20%. A technology company delivered in October of last year, up 38%. A financial services company delivered in December of last year, up 40%. Another financial services company delivered on September 18th, 2024, almost exactly a year ago, up 89%. Super Stock Bundle 2.0, the performance continues with winning picks showing gains of. So let me be clear for a second. These are all stock picks from Stock Bundle 1.0, and then from Stock Bundle 2.0, Super Stock Bundle 2.0, the outperformance was just as good. Winning picks in March of 2025, Industrials Company up 33%. Consumer Cyclical Company from March of 2025, a recommendation in March of 2025, up 34%. A Basic Materials Company from May 2025, up 34%. A technology company from April 2025, up 42%. And today, I'm happy to report that we have identified a new bundle of super stocks for you, Super Stocks 3.0. If you're new here and are unaware of what I'm talking about, don't worry. I will still be going into detail in this training to give you the full context on what a super stock is and how we validated it. So for now, sit tight and let's dive in. Here's what we'll be covering today. What a super stock is and the golden metric that we use to find these special stocks that beat the market. We don't even have a model portfolio for these. They're so special, there aren't enough of them. Now, we'll also talk about how accounting loopholes distort a company's true earnings potential. We'll show you exactly how you can grab my latest super stock picks based on the latest discovery in our data. And free bonus at the end, if we have time, we will analyze 3 stocks based on popular demand. For those of you that don't know me, I'm David Trainer. Pleased to meet you. I'm author of Modern Tools for Valuation in the Valuation Handbook, and I've been working on machine learning and robo-analytics AI for coming on almost 30 years now, but definitely over 25 years, but getting close to 30. If you're one of our new members and wondering why you should use our research and stock picks, we've got a lot of good evidence for you here. First of all, our stock picking has beaten 16,000 buy-side professionals to claim the #1 spot in multiple categories for 51 straight months, according to SumZero. Here you can see straight from their website. SumZero is a community for professionals. So this is not retail folks. This is not Wall Street folks. This is buy-side professionals, people who pick stocks for a living. We make the #1 ranking 51 months in a row. That should be good. Good enough for most people to trust us, but there's more. Our work has been vetted and validated by prestigious institutions such as Harvard Business School, the MIT Sloan School of Management, Ernst & Young, and the Journal of Financial Economics. Name another research firm in any field, much less investing research, that can claim vetting and validation from that many folks and folks of that level of prestige. But I can even take it another step further. The performance of our actively traded indexes based on our research proves our alpha. Let's talk about that. The Very Attractive Stocks Index, beating the S&P by about 2% or more year to date. That was just a few days ago. 2%, beating it by 2% year to date, beating it by 70% over the last 5 years. That's the S&P, folks, not just any index, probably the strongest index in the world over the last 15, 20 years. The core earnings weighted S&P 500. It's not beating the S&P 500 by as much, less than a percent, but that's as of, again, September 15th. But over the last 5 years, beating it by 29%. And then there's the core earnings leaders index. It's beating the S&P 500 by 8% year to date and by 41% over the last 5 years. These are live traded indices. Kyle can drop a link into the chat that shows you how you can get access. Take a look at these indices for yourself online. The tickers are right here. If you wanted to write this ticker down and search for it on Google, you could take a look. There's that ticker, and that ticker. So yeah, see it for yourself. Seeing is believing, and there's nothing like live traded performance. I hope to impress you with the alpha and the proprietary power in our data. But today, I'm going to take it to another level. I'm going to show you how to get my latest super stock picks. Not show you to do research or to use an index, but give you specific picks which could rival the performance of our previous picks. This new pick is not found in any of our current model portfolios. These picks are based on a combination of 2 very stringent criteria: a golden metric that we've been studying, backtesting, and have validated, and the proven superior stock rating system at new constructs. This pick should not be taken lightly because our stock track record speaks for itself. Again, recently ranked #1 in multiple categories for 51 straight months on one of the biggest buy-side stock picking contest platforms in the business. And as much as I'd like to give myself credit for these #1 rankings, you all know it's really all based on the proprietary robo-analyst technology in our stock rating system. This is a technology-driven business. You don't have to worry about me and what mood I'm in and how that might affect stock picking. There's a system here, a proven system. And in this training, not only will I test some of your favorite stock tickers against our rating system, I'll be showing you how to grab my #1 new pick today. We believe it's especially important to hear our message today. Not only does the market continue to be really overvalued. But September is also historically the worst month for US and global stocks. The S&P 500 and the MSCI All Country World Index have averaged a negative 2% return over the past decade. Just look at how the market's performed so far this year. Today, it's getting wobbly, folks. 4 out of the last 5 Septembers have been negative, with the steepest drop in 2022, which was 9%. Even in today's market, though, there are great investment ideas, especially after uncovering and now validating our proprietary metric over the span of a year. Our team is constantly analyzing our proprietary and proven superior data to find new, better ways to pick stocks. And last year, after researching and completing back tests on stocks, the results were astounding. And the outperformance of the picks further confirms that our theories are true. We have evidence. Our golden metric finds stocks that no one else can find because no one else has our data. Part of the reason these things outperform is because nobody knows about them. The main reason these stocks outperform is because no one else can find them. Look, there's 2 kinds of research in this world. There's the stuff that everyone else does, that you see on the CNBC, that you see on your screeners on Thinkorswim or Schwab or Interactive Brokers or any of these platforms. Technical research is like leaves on trees, like they're everywhere. And they die. You can never trust that they're going to survive for very long because it's something that everyone else has. The second kind of research is the stuff that only great investors have and gives them the edge to outperform and make money. It's the stuff that nobody else has. Today, we're going to give you an edge that almost no one else has ever had. It's based on a recent discovery and indicates an excellent long-term future with potential triple-digit gains. Stocks such as Domino's Pizza. When we identified that this golden metric was in place, it went on to go up 2,300%. Accenture, when we identified that the golden metric was in place, up 1,100. AutoZone, when we identified the golden metric was in place, up 1,000%. These great stock picks led us to do more research. A friend of mine in the business was like, David, dude, what is Domino's? Like, did you notice anything special? And when we looked and we found, oh my gosh, there's this golden metric here. And I noticed this golden metric is unusual to begin with because the situation or the golden metric is a very rare sighting through my whole 25, 30 years. Very rare to ever see this golden metric in place. So we did some more research and found that it is indeed very rare, and it is indeed a very strong indicator of excellent future performance. So what is that? What is this golden metric? It is when economic earnings are greater than accounting earnings. How exactly do we calculate economic earnings? And by the way, this is a proprietary metric that no one else calculates as well as we do. Same is true for all of our metrics, right? Core earnings, invested capital, NOPAT. People talk about these. You can go on ChatGPT and they'll talk to you about NOPAT and return on invested capital. And they'll even give you some shortcut formulas on how to calculate it. Calculations aren't the trick, folks. Having the data right is the trick. It's the incremental better data. Lots of people have stock ratings, but nobody else has a very attractive stocks index that outperforms, right? It's the data that matters. And so the data that drives our model here for economic earnings is what's key. Why are economic earnings in general a better way of measuring profits? Well, all the greats through time have mentioned it, but the key reasons are, number one, they're based on the complete set of financial information, especially footnotes, our version anyway, right? Second, they're standard for all companies, apples to apples, despite accounting rules and different accounting rules that companies choose, and as well as in different accounting regimes in different countries. It's a more accurate representation of the underlying economics of the business. And by the way, they're better for finding hidden gems in the stock market. So here's an example for Groupon. NOPAT minus WACC times invested capital, negative 22 million of economic earnings, but their GAAP earnings were positive 21 million. Anybody remember what happened to Groupon? How about Bumble? We showed negative economic earnings of 383 million and GAAP earnings of 318 million positive. Anybody remember what happened to Bumble after 2021? The bottom line here is that if the company is not generating positive economic earnings, it is not creating shareholder value, and it could go to zero. Economic earnings are the best way to measure shareholder value. Now let's show you how this has worked in the past and have a look at the stocks we mentioned before to see the hidden metric in place. So, mentioned Domino's Pizza. When we crunched the numbers in March of 2005 on the latest 10K, we saw that economic earnings are greater than GAAP earnings, and since then the stock is up 2,300%, 2,310%. The S&P is up just 459%. Here you can see a picture from the model where the economic earnings were greater than GAAP earnings. Accenture, same story, different time frame. We got the 10K, we did the work, stock went on to go up 1,200%, while the S&P was up only 651%. We saw economic earnings strongly above accounting earnings. AutoZone, up 1,000% after we noticed that economic earnings were greater than accounting earnings. Now, it's important to realize just how rare this metric is. More on that later, but just let me tell you, rarely had I even seen this metric in place in my history, in my career, even before we had a database. Very rare. It's also important to understand how large the true difference between economic earnings and the reported GAAP earnings can be. Over the last 25 years, I found more than 30 GAAP loopholes that can distort a company's earnings. I've even published white papers in every single one of them. You can get them for free from the website. Kyle, if you want to drop that link from the education page in there, we will give you these reports, these forensic accounting books for free. Why? Because we want you to know how much work we do. And also we understand that the value is not in actually reading these reports or knowing what the adjustment is. It's being able to execute it at scale. It's being able to get that data at scale. That makes the difference. It makes all the difference. Sometimes these distortions can occur by chance, but more often than not, they are deliberate. I've been doing this work a long time. And I can tell you that if companies wanted to really give you the truth, they could do so quite easily. They choose not to. The flexibility in the generally accepted accounting principles or GAAP rules creates loopholes that companies can exploit to manipulate their reported earnings. Go Google misleading earnings or can companies manipulate their earnings? There's millions of papers on this, folks. This is not new news. But the bottom line is that the numbers can be manipulated to make earnings and profitability appear more impressive than they truly are. And companies and Wall Street encourages companies to do this all the time to help them sell stock. That's the tough truth. You cannot trust GAAP earnings or any earnings from Wall Street. Now, thankfully, over the past 20 plus years, we've trained our system, our technology, our AI to identify and close these loopholes and uncover the true distortions between economic and GAAP earnings. It helps warn investors about bad stocks in the market, such as Beyond Meat. Bad rating in our system, down 96%. Groupon, unattractive rating in our system, down 91%. Allbirds, unattractive rating in our system, down 98%. But it also helps us spot good stocks that can lead to triple-digit gains. Bath and Body Works. When we noticed that economic earnings were greater than GAAP earnings, stock went on to go up for 430%. Natural Resource Partners. When economic earnings were greater than GAAP earnings, stock went on to go up 260%. DXP Enterprises. After we noticed that economic earnings were greater than GAAP earnings, the stock was up 160%. Now, anybody have any questions here about what's going on and how economic earnings are a better measure? Please jump in here because I want you to understand this is an amazing indicator that you can only get from new constructs. And this isn't like a foreign concept, by the way, right? This very much aligns with Warren Buffett's philosophy, where he highlights the difference between a good company and a good investment. He says, look, investors making purchases in an overheated market like today need to recognize that it may often take an extended period for the value of an outstanding company to catch up with the price that you paid. In other words, if you pay for stock and the earnings aren't really there, well, shoot, it's going to take a long time for the earnings to grow into that valuation. What we're showing you are stocks where the market has misperceived how strong the earnings are, where the market underestimates the value because it doesn't see the real economic earnings. It's an investing superpower to find companies earning significantly more than what the market perceives. Superpower. That's how you get an edge like the greats. But you can only do that if you have the right research and data to see where GAAP earnings are greater, where economic earnings are greater than GAAP earnings. To see where economic earnings are greater than GAAP earnings. Heads up, Google or ChatGPT will not give you an accurate list of companies where economic earnings are greater than GAAP earnings. Their numbers are based on faulty data and will not give you a good read on what's really happening, but we can. Those of you that were on our monthly podcast last Friday, you saw me demo the AI agent that we built with Google Cloud that takes advantage of this data. And when you saw me compare the results to what you get from Perplexity Finance or from GPT, and guess what? Not even close. Our stuff is way better. The only good thing about GPT is that it does reference new constructs as the best source for this kind of data. Good for them. Now here's what our system looks like. Here's and if you're a professional subscriber or institutional member, you can see charts in our system that compare economic earnings and accounting earnings. You can see for a couple different companies here, this is how we're identifying and it's what we're seeing and how the trends are looking. When this metric is in place, eventually those profits can catch up and boost the stock. Eventually the net income catches up to the economic earnings and the rest of the world sees just how profitable this company is. The key for you and for any investor, you got to get in before the crowd. You got to be there before everyone else is. You have to know something other people don't know. Now, I should be transparent with you. Although our hidden metric of economic earnings greater than GAAP earnings is extremely powerful and rare, it's not the be-all, end-all to find a quality stock pick. It's still important to find a stock with the golden metric in place that also is cheap, poised to explode. That's where our stock rating system comes in. Our ratings are powered by our robo-analysts. You can see there's 5 criteria here. You've got economic versus reported earnings, which is something we're always measuring, always been part of our rating system. And we are looking at trends here, but the special thing about the golden metric that's not captured in the rating system is this doesn't really tell you whether or not economic earnings are greater than accounting earnings. The reason I couldn't build it into the metric, because it happens so rarely, nobody would ever get a good score. So we had to add this as a special layer. Then we got return on invested capital and 3 valuation metrics. Why 3 valuation metrics to just 2 profitability metrics? Because valuation matters. There's a difference between a good company and a good stock. If this company's super profitable and the valuation is extremely high, take NVIDIA for as an example, super profitable company, but the valuation is absurdly high, you need to know that. That matters more. No matter how profitable the company, if the valuation is too high, you don't want to be in the stock. So we got 3 valuation metrics: free cash flow yield, price to economic book value, and the market implied growth appreciation period. Now our AI has the ability to comb through thousands of government filings with precision, analyzing every line and footnote. Some of the most successful investors and firms in the world have been clients of this data. Our superpower is finding earnings distortions across thousands of publicly traded companies. It's one thing to go in and do a case study on a company and you get lucky and it has earnings distortions. But to understand whether or not those distortions are big relative to the rest of the market or all the other companies, that's the power. That's where scale is important. You can see the 5 key metrics in our system for our rating system explained again here. And the key thing I want to point out here is that we're making it simple for you. We're going through all this data. We're looking at earnings distortions. We're comparing those distortions across all companies to see who's too big and too small, where the extremes are. And then we boil it down to super simple signal. Green is good and red is bad. These metrics help us gauge the quality of a company's earnings at scale, as well as the value of the stock, and determine if the stock is priced correctly in relation to the true earnings. Now, this system is so good that Harvard Business School wrote a 60-page paper proving the superiority of our ratings. Not bad. How many other research firms do you know that have ever had a paper from Harvard Business School or any college or university or business school for that matter written that proves that their ratings are superior? Put it in the chat and I'll give you a free report on the ticker of your choice. It's also the only research system with a patent. A patent. Why? Because no one else can do what we can do. As our robo-analysts process and structure data from over 200,000 financial filings, we have optimized the singular best AI for investing when it comes to fundamentals in the world. It's a cool slide that I show to all my clients and investors, right, about the auto parsing technology, our proprietary ontology, and the footnotes and MD&A analysis. These are all three things that no one else has. No one else has. And this is why our research is special and delivers alpha. So when we're talking about 200,000 filings, I want you to know that's twice as many as Warren Buffett has done in his life. I think that's a big deal. We built an AI to replicate what Buffett does and more, whether it's Ben Graham, whether it's Adam Smith, whether it's Merton and Modigliani. We've built a system to implement this, and it's time. The technology's here. The proprietary technology to standardize complex financial disclosures into accurate measures of economic earnings and core earnings gives you an edge. And these metrics are proven vital for assessing a company's true financial health and for generating alpha. Does it get any better than that? You guys ever want to hear me talk about alpha or AI? You should check out this interview I did at the Stansberry Research Conference. It's a great 5-minute clip on why our AI is special and how to avoid the smoke and mirrors and other AI. There's a lot of smoke and mirrors out there. I explain how to avoid that and how you can identify real AI. Because look, as Tom Brady likes to say, to win in this world, you have to be willing to do things other people will not do. You have to work harder than they are. You have to do things that they're not willing to do in order to distinguish yourself. Doing the same thing that everyone else does, that's going to get you the same old results. You want extraordinary results, you need extraordinary effort. And our robo-analyst technology is able to deliver alpha from the footnotes because of the extraordinary effort we put in to teach a machine how to do things that only expert humans can do. Most investors and professionals, they're not willing to do it. They're not willing to put the time in to read a few 10Ks, not to mention 200,000. Because it's hard work going through a 200+ page filing. Most Ks and Qs, you guys know the average length is 200 pages. Some of them are 2,000 pages. It's a lot of work, but that's what you got to do proper diligence. And this process would cost millions of dollars per quarter for firms to get the proper calculations, to get the proper data and calculations. That's another reason why nobody does it. It's super expensive. Even if they tried to do it, they may not be successful. Very expensive experiment, millions of dollars a quarter. And that's why it's so much easier for firms just to blast out, buy. I think somebody in the chat mentioned here recently, they recently got burned by Kramer. It's not his job to do good research, it's his job to entertain. Here's another big sad truth about the way the world works. 96% of stocks covered by Wall Street get a buy or hold rating. How efficient could the market? You can't even make an argument for market efficiency if 96% of all stocks are buy or hold. Everything's a buy. Own everything, right? We know that doesn't work. That's why so many people underperform. That's why Wall Street analysts underperform a huge amount. And the reason there's so many buy ratings out there is because their paychecks depend on you buying stocks. Their paychecks depend on their ability to sell stocks. That's how they make money. Does anybody know how much money that the typical Wall Street research department makes? Anybody want to know? Percentage of revenues that come from the equity research department or fixed income research department for Wall Street firms. Anyone want to make a guess? How about 0? The research departments don't make money. So guess what happens if they have an opinion that doesn't make the bankers happy? Get fired. Seen it happen firsthand. How do the bankers make money? Selling stock. So if you're not helping the firm sell stock, you're on the outs. Why else do you think Wall Street wants you to buy or hold 96% of stocks? On the other hand, in our system, less than 13% of our stocks get an attractive rating. Less than 4% are listed as very attractive. Now, we've already mentioned Wall Street wants you to buy 96% of stocks, buy or hold. And according to recent data, 57% of Wall Street ratings for stocks are listed as buy compared to our 13. Look at that. Here's a quick sample of how our stock ratings compare to Morningstar stock ratings. Very different. Notice they got a lot more buys than we do. They make money selling their research to companies, right? You know that to display your Morningstar rating as a mutual fund, you got to license that from Morningstar. They're conflicted. Here are more examples of misleading Wall Street buy ratings and how they compared to our honest ratings. Specific examples where Wall Street was bullish, we weren't, and what happened. New Fortress Energy was a buy from, according to Wall Street, over the past year. Unattractive in our system, down 91% over that time frame. Who was right? For Wall Street, according to Wall Street, Wolfspeed was a buy or hold for most of the past year. Unattractive in our system. Guess what? Wolf is now down 77%. How about Moderna? Buy or hold for most of Wall Street over the last year. Unattractive, very unattractive in our system. Down 41% over the last year. Who are you going to trust? I said this before and I'll continue to say it. Trusting Wall Street research is like trusting tobacco companies saying cigarettes are not harmful or addictive. So, why is our research different? We've done the diligence. We've done that hard work. We've done the work that other people aren't willing to do. And we uncover critical data that is often legally and illegally buried in the footnotes. So you may be wondering, sure, your stock ratings at new constructs are different from Wall Street, but how do we know they are better? Check out our stock ratings. Check out the institutions that have written papers proving the superiority of our data, of our financial models and metrics, and our ratings. Don't forget all those indices that outperform. And not only does our research protect you from false buy red flags, it helps you find the true buys, those stocks that are attractive or very attractive based on our superior research. Remember, only 13% of the thousands of stocks we cover get a good rating. And when you find a stock that has both an attractive or very attractive stock rating and economic earnings greater than accounting earnings, you'll be able to find stock plays that can potentially demolish the S&P in the next few years, such as Capri Holdings. When we noticed that economic earnings are greater than GAAP earnings, after analyzing its 10K, it was up 220% in the next year. Funco, when economic earnings were greater than GAAP earnings, notice that in the 10K filed in March of 2020, it was up 110% within the next year. Argonne, similar situation. We parsed the 10K, saw economic earnings greater than accounting earnings, up 90% in the next year. So that's the primary reason I invited you to be here today. We've just uncovered a new stock with an attractive rating. It's a stock we believe could perform exceptionally well in the near future based on the two criteria we've been talking about. The companies that earn our highest ratings and have economic earnings greater than GAAP earnings. These stocks are not based on hype. It's not a stock you're going to hear about on CNBC or Yahoo Finance, but it has all the right criteria in place to thrive in the months and years ahead. With this stock pick, we found a company with economic earnings greater than GAAP earnings. Here's the distortion we saw between economic and GAAP earnings. And here's our current stock rating. In our eyes, it's only a matter of time before the stock price jumps to reflect its superior economic earnings, just as our previous top pick did last year. Financial services company, the number one pick, the first ever super stock 1.0, 89% within a year. If you're interested in the name and ticker symbol of our next number one super stock pick, all the details are included in a fresh report I prepared. It's called my number one super stock 3.0 pick. Want to see it now? Go ahead and click the link in the chat we provided. Kyle will probably roll that in here. There you go. That's where you go to get this report. Now, I want to emphasize how rare an opportunity like this is. Based on our current data, only a small handful of companies have the hidden metric in place. I think only 2 or 3 companies in the entire S&P 500 have this one metric in place. Even fewer have an attractive or very attractive rating. We scan thousands of stocks, and there are precious few stocks that meet both of these special criteria. That's how we know this opportunity is extremely rare. It's not likely to come around again anytime soon. Like I mentioned, over the last year, we've only had 2 of these bundles, only 2 times a year, and both of them done extremely well. These stocks don't come along very often. I mean, we literally had to comb through and do a lot of extra research on top of what we already have to find stocks that we could put into Super Stock Bundle 3.0. So I suggest getting this as soon as you can. It's uncommon for companies like this to remain unnoticed for long. Look, once we let this out into the public, I can't guarantee that these stocks don't go up right away. I can't guarantee that you're going to have time to get in these stocks after this thing goes public. This is especially true for today's current market. Of course, we can't promise a triple-digit return on this pick or any other picks for that matter. But I can say it meets the same 2 criteria as the successful stock picks I've shared with you today. It has an attractive risk-reward rating and attractive or better ratings in all 5 component metrics. It might not be the next NVIDIA. However, it's within reach to achieve returns comparable to those we've seen from stocks with this hidden metric before, including Dell Technologies. When we parsed its 10K in March of 2023, we saw economic earnings greater than GAAP earnings up over 200% in the next year. Vail, we parsed its 20F in March of 2020. We saw economic earnings greater than GAAP earnings up 140% in the next year. Medifast, economic earnings greater than GAAP earnings up 108% within the next year. It's important to note these stock picks go above and beyond our typical rating system. They are considered outliers, even amongst the attractive rated stocks in our system. We have not placed these stocks in a monthly portfolio yet. They are special picks that receive a new super rating. Why? Because not only are they rated attractive or better, they also have this hidden metric that no one else is able to see. We've been building and refining our data for over 2 decades now. We updated data, new prices, and any new filings from the SEC. We take a look at least once a quarter and update all of our models on the 3,300 stocks that we cover. That means there are always new ideas coming out of our research. However, we still get very, very few stock picks with these special 2 criteria in place. And when we do find these stock picks, we pay extra close attention because most of the time, these stocks will have a say. It is time to back up the truck. With number 1 super stock pick for 3.0, you're going to get a very detailed report, just like the one you see here. This is the kind of report that's usually available only to our professional members who pay us close to $12,000 a year for access to this kind of research. And to ensure you get off to a swift and successful start, I'll also be throwing in a bonus founding members only call with me. I'll show you how to read the detailed report and analyze the data behind my most recent stock pick. And of course, you'll be able to ask me questions on the call. Ask me anything today and then as well. With this type of potential on the table, it's easy to see why some of our clients pay us $11,000 a year to see our stock ratings and research reports, and for good reason. More than $11,000 a year. The comprehensive nature of our research entails countless pages of data and documentation, including information from balance sheets, income statements, cash flow statements, footnotes, dozens of other disclosures. Producing and maintaining this level of detailed research would set you back millions of dollars each quarter, assuming you could do it, assuming you could assemble the experts with the requisite expertise to do this kind of work. Our higher level memberships and new constructs give you access to a level of depth of financial research that's considered a gold mine to financial analysts, hedge fund advisors, and mutual fund managers around the world. This high level research consists of unbiased ratings, superior ratings on 10,000 plus securities, portfolio tracking, screening, and detailed reporting and database access to put together reports to do research like what we've done on our own. We go far beyond the competition with the quality and integrity of our research. But today we're talking about something different, where you don't have to do this kind of detailed research in our professional and institutional memberships. You could say this deal's even better because we've done the work, we've done the screening, we've done the research to find the stock picks that pass our strict criteria. And I'll be delivering it to you on a silver platter. How's that? This is also a new special offering coming from New Constructs, as you won't be able to find super stock picks anywhere on our site. The only way to get the super stock picks is through this special offer today. I won't be charging anywhere near the price of our institutional professional memberships for this special offer, because by excluding the special features and tools in our higher memberships, we've been able to bring the price down to just $19.94. And today, though, we're going to do something even extra special. You see, you're here with me live, and I'm sharing something special and exciting with our community. So instead of seeing a $1,994 price tag, I'm going to give this away to you at Founders pricing for just $699. $699. And if you join now, I'll be throwing in 2 more of these special stock picks over the next week. That's 3 super stock picks that meet our super strict criteria of attractive or very attractive rating and economic earnings greater than GAAP earnings. These stock picks closely align with Warren Buffett's philosophy, where he highlights the difference between a good company and a good investment. You need to recognize that if you buy stocks and the earnings power is not there, you're not going to see great performance. However, when there's more earnings power than what the stock market sees, you've got huge opportunity. Each of the stock picks will come with one of our detailed stock reports. It's an 8-page report that's as good as an entire financial model. Each one of the reports, in my opinion, is probably worth at least $10,000. That's what it would cost you to hire an expert with the requisite expertise and knowledge to build a model as good as we can. That's what it would cost you to get them to do that, I think, for just one company. And you're going to get that along with the picks when they're revealed. Our stock ratings often change, and so do economic climates, especially after earnings and filing seasons. So over the next month, I've committed to selecting even more super stock picks based on our strict criteria. So here are the options I'm offering you today for our Super Stock 3.0 bundle. And option number 1, 3 super stocks released within 1 week. Get 1 immediately as soon as you buy, and 2 more within a week. That's $699. Option 2, 5 total super stock picks delivered within the next month. So you get 3 within the next week. By the end of the month, I guarantee you will find 2 more. That's $899. And each one of those picks will come with one of our detailed reports. They'll be selected, each one of these picks will be selected based on market conditions and what I believe will be the best time to buy. The bottom line is that you're going to receive 1 super high value stock pick immediately and up to 4 more depending on which option you select, guaranteed. This special offer aligns with a quote by Justin Welsh. Modern luxury is the ability to think clearly, sleep deeply, move slowly, and live quietly in a world designed to prevent all 4. What does that mean? When you have something that is based on work that no one else has ever done, technology that no one else has ever had, expertise that very few people in the world have and has been applied in this way, you're able to operate at a level of proficiency and success that the world doesn't want you to believe is possible. That's how special New Constructs research is. That's how special this offer is. So if you're ready for me to put the robo-analyst to work for you and take action on an extremely rare and valuable super stock pick and up to 4 more, go ahead and click the link in the chat that we provided and sign up and take advantage of this offer before it expires. Remember, you'll be getting stock picks from the same research that has earned the #1 rankings on SumZero for 51 straight months. Here are a few quotes from our clients, in case you wanted to get some validation from other people. I'm sure there's some people on this call that have been following us for a long time. Feel free to put some stuff in the chat about what you think about new constructs. But here specifically from Joe, simply and instantly, you can see how your stocks or funds are rated and where they are trading compared to economic book value. For someone with limited time to spend watching the stock market, this top-down view is incredibly useful. I highly endorse the new construct rating system as one must-have tool in any stock or fund selection system. Chris C. I sincerely appreciate all the work that has gone into creating new constructs and the database. Going from marked up footnotes and filings to reliable, easy to understand indicators of a company's performance is a huge undertaking, and you deserve my utmost respect. I find new constructs information to be reliable, relevant, and trustworthy. I expect to continue using new constructs throughout my life to avoid ever running out of money. New Constructs is the only company that has allowed me to feel secure in both my buy and sell decisions, and that has been truly valuable. Let me know if you've ever seen a better testimonial for a research firm than that right there. Maybe this one from Kurt. I found your analysis superior. Many stock ratings systems are available, but as a business owner, I know how financials can be manipulated to put forward best case scenarios, thus hiding critical information. Your research digs that out for me, provides a high level of confidence in my selection process. I use other metrics to compare, but I rarely buy something that does not have solid ratings from new constructs. I maintain all my investments in one of several portfolio listings on your platform, which allows me to quickly reference the asset if I see something happening. It's pretty good, guys. Pretty good. Pretty good. So here's everything you're getting if you join today. You get my #1 super stock pick. You get 2 more high value picks and a founding members only live training. All that for just $6.99. $6.99 for something that could be valued up to $4,000 or close to $4,000. That's saving you $3,000. Not to mention the trouble of having to figure out what you want to invest in an extremely overvalued market. Why such a great deal for stocks this valuable? It all comes down to our mission at New Constructs. Our mission is to improve the integrity of the capital markets, which makes our research perfect for today's market. I want to emphasize this. My mission has been to improve the integrity of the capital markets. Why? Because I believe healthy capital markets leads to the most successful society possible. When we make more out of less, we are good stewards of our capital and of our resources. That's what makes society better. And that's what New Constructs helps people do by identifying those stocks that are most undervalued and bringing capital to them so that those companies that are doing great things and earning real money are able to grow and be successful. And I want to help people take capital away from the overvalued stocks that aren't profitable, because those companies don't need more capital and they should not have more capital to put into businesses that aren't profitable. If you sign up for any other offers, question in the chat. If you signed up for any other offers, and they overlap with what we're doing with super stocks, we will certainly make sure you don't pay twice. But I will tell you, super stocks are not included in any other offer. It is in addition to the institutional membership, the pro membership, and any other package that we've had in the past. So that's a big difference. The super stock is over and above anything you will have bought from us from the past. Common question #1. What if I already have access to the previous super stock bundle? Will they all be the same stocks? No. These are brand new stocks, a brand new bundle. There'll be no overlap. #2, how many stocks will I be receiving in total? Depends on the tier you decide to join. You will either receive 3 or 5 stocks total. So no matter which tier you select, you will immediately receive the first super stock delivered to your inbox. #3, are the super stocks released in the new bundle guaranteed to have a double or triple digit gain in the next year? No. No, no, no. Nothing is guaranteed. No stock rating system can ever promise a specific return. If it does, it's probably not telling you the truth. While we are highly selective with which stocks we grant as super stocks, we cannot guarantee the stock will explode in the near future. Common question #4. How do we know New Constructs stock picks outperform? See our live traded indices provided by Bloomberg. You can't get really better evidence than that. Look at what SumZero says about us. Look at what Harvard Business School, MIT Sloan, and Ernst & Young say. Can't get much better evidence than that. There they are. Very attractive stocks index, up 70% over the last 5 years. Beats the S&P by 70% over the last 5 years. The core earnings weighted S&P 500 index beats the S&P by 29% over the last 5 years. The core earnings leaders index beats the S&P by 41% over the last 5 years. Let's see what we got else in the Q&A here. If Trump is successful in moving earnings reports to 6 months from quarterly, how will that impact our research and models? We'll just have data less often. But to be honest with you, it doesn't matter to us. Quarterly earnings are great updates, and it helps us on the health of the business. But at the end of the day, there's too much noise there, right? Expectations don't change that much. Businesses don't change that much. And that's why super stocks are so rare and so hard to find, because there's just not a ton of turnover in terms of how many companies generate economic earnings greater than accounting earnings. It's a rare thing. And no matter how often they report, the data doesn't change that much, because the number of businesses that are that good is extremely rare. And when you find great businesses trading at discounts or cheap, right? When the golden metric is in place and the stock rating is attractive or better, that's a very rare thing and a very special thing. All right, time to take a couple requests. Put in those tickers and let me know what you think, or which ones you want me to talk about. Let's see here. We got a couple minutes. Let's take some requests. Kyle, what do we got here?
The first one that came in, David, was RY.
RY. Okay. Let's go website. RY. Royal Bank of Canada. We've written about this stock a few times. As early as January of this year. See, it's actually done really well. We've got an attractive rating on this stock. I like it. Economic earnings are not greater than accounting earnings. Even though it's been a long idea, one we liked, it's got a great rating. Great rating is sometimes, most of the time, all you need. What else we got, Kyle?
That's the only request so far. Not to pile on, but HYFM was the one that Kramer burned someone on.
Okay. Yeah, this is what Kramer is recommending. Yeah, it doesn't look good. Negative economic earnings, trending down. Number of shares going up, not good. Return on invested capital, trending down, not good. Very expensive, bad stock. It was over a year or so ago. Well, it looks like back in 2024 wasn't looking much better. We had pretty much bad. So we can actually look at the rating history. You can see a year ago, so that would be around this time, an unattractive rating back then as well. I see a couple more here. Let's take one more request before we go. We're right at an hour. Walmart. Classic. Good company, bad stock. I think a lot of these great companies have become crowded trades, everybody, because I think the meme stock investors, some of them, got smart. They said, oh, I can pile my money into a terrible company that might go bankrupt and hope that everyone else does too, and I get out before it crashes, or I can pile money into a good company. And I think that's part of what pushes stocks like Nvidia and Walmart way up, because they are good companies. They are very profitable businesses, but they are super expensive. All the good news is priced in. Well, thanks very much for being with me today, everybody. Very proud of our Super Stock 3.0 bundle. Very proud of how the past Super Stock bundles have done. As you've seen with the stats we went through, those Super Stocks have done extremely well. And it's because they are rare, super discerning. So rare we don't have a model portfolio. We can't have a model portfolio. We can only really do this kind of promotion maybe once or twice a year, because there are so few of these great stocks. But the good news is, when you get in on them and you get in on them early, you got a great chance to outperform. Thanks very much. Have a great day.